We got some good news today. At least that is what it looks like on the surface of it and what it looks like in terms of the market reaction. Now, we're going to debate that later in the video, how good of news the CPI report was today, actually. But nonetheless, the market is receiving good news, yields are falling, and stocks are up. So that begs the question, how much good news is priced into this market? Because definitely a lot of it is priced in. We're seeing a tremendous stock market rally. In many stocks, a quite big one, almost to new all-time highs. Apple, Microsoft, etc., these are obviously staple companies, but how much good news is actually priced into them? Well, my read on it is that quite a lot of good news is priced into them. They have essentially been priced for a continued Goldilocks environment. However, it appears quite clear that the Goldilocks environment of the pandemic boom is not continuing. So the bar is quite high for these stocks, and the risk reward is highly questionable. Now, I'm not saying these companies are bad companies that are going bankrupt. This is the end of their run. I'm talking about the stock and the stock price and the market environment. And that market environment is quite interesting because I believe the advanced decline line of the NASDAQ hit an all-time low today. That implies that there's significant divergence in this market. And we can see that. We can see that when we look at the Dow, when we look at the S&P 500, and then when we look at the NASDAQ or the Qs. So definitely some divergence going on in this market. The concentration continues to grow, and it's just a few stocks that are performing extremely well. If those stocks continued at the kind of growth rates they had in the past, then yes, they should probably be closer to all-time highs. Although the interest rate question becomes quite interesting because they benefited the most from low interest rates, and more so than other tech stocks because they got the TINA benefit. Let's not forget, the bond market is bigger than the stock market. So when interest rates were near zero and very low, offering very little return, particularly compared to inflation, how much money printing was going on, these stocks made sense to own. They were actually more compelling than a treasury bond. But now treasuries are offering better returns. And these huge sums of money, the biggest players in the market, that's what they're doing. That's what they're doing. That's why people are looking at allocations to stocks compared to the COVID amounts. And it's not necessarily a relevant comparison because treasuries were so low and because such big retirement funds, etc., were going to mega cap over bonds and are now going back to bonds. Different environment, in my opinion, justifies different price action. Yes, they are still somewhat off their all-time highs, but they're quite high still. So these stocks, in my opinion, pretty expensive. And I think a lot of good news is priced in. I think a lot of the inflation is coming down news is priced in. And then that begs the question, is inflation really coming down? Well, we know what's happened with gasoline prices. That's obviously been a big contributor to the CPI. But when you look at core inflation, we've been above 5.5% in core CPI for 3 months in a row. It's basically been flat those 3 months. And actually, the month-on-month change re-accelerated. So I get it. Some people want to break it down into its components. But let's not forget what the Fed says about one individual inflation report. You can't only take one inflation report into isolation. Used car prices, for example, had been declining many, many months in a row, and then all of a sudden, they're up in April. That was quite interesting. And I get it. Some people are like, oh, used cars, not that important. Well, they're pretty important for the American economy because not only does it include trucks, which are very important for various industries, but employed workers need cars to get to work. So it's a pretty important aspect of the economy. Also, it affects insurance, which is another aspect of the inflation reports, which also was up this month. So I think there's some important things to consider and digest. And the move, in my opinion, is not necessarily to look at the headline number coming down, because the Fed, while they do care about that, says explicitly that core inflation is the better read on inflation. And that is not moving down in such a convincing way. It's honestly pretty debatable how convincing of a way it's moving, because we're now on tougher comps. And when you see that we're now in tougher comps, the numbers are actually quite flat and not doing anything notable to the downside on a month-to-month basis. So I'm not getting as bulled up about the inflation report as the market is. I'm acknowledging that it's good. It's good to see headline CPI come down. It's good to see inflation not accelerating in such a dramatic way. But given where we are, I think we have to beg the question and ask the question, how much good news is priced in? And then evaluate what the risk-reward potential is. And my opinion is there's much more exposure to the downside than there is possible additional gains on top of what we've already seen this year. So that's how I'm thinking about things. But obviously this market has been incredibly surprising. So my exposure to that is reflecting such. And I'm not going too deep towards the downside at this point. So we're going to have to see how things play out. But that's my read on the CPI today. The market obviously very volatile today. Who knows what side it's going to end up taking. I think we have some important Fed speakers tomorrow, or Waller tomorrow and then Bowman on Friday. Both two people on the more hawkish end of the spectrum. It will be important to see that perspective, because so far we've had two more dovish members and we've had two more hawkish members speak. We've had Jefferson and Goolsby being somewhat dovish, and we've had Williams and Bullard being somewhat hawkish. And doesn't seem like a pause yet. I read the Nick Timiraos article today. He kind of hints that maybe this would be something of a pause, but Williams said just yesterday, we're not pausing yet. So we'll see what happens. I'm not suggesting another rate hike is imminent. I'm suggesting we not be so binary and conclusive based on this CPI report, because it's really not conclusive, and it's not conclusive because of the core inflation. So, one day at a time, that's today's video. And until next time, peace out.